Futures, what is that? Hey taxpayers, it's Tiffany Gonzalez CPA here, founder and CEO of Accounting to Scale. And we're back with another installment of What is That? Where we discuss financial terms and topics you may have heard, but we make them super easy to understand. Today, we're talking about futures. No, not the rapper. This has to do with investing in assets and commodities. So if you've heard the term and want to learn more about it, tune in and let's start right at the beginning. Futures, what is that? Futures, also known as futures contract, allow an investor to lock in a price of an underlying asset or commodity. These contracts have set expiration dates and set prices that are known in advance. Futures are identified by the month in which they will expire. Basically, the future is a financial contract that obligates both the seller and the buyer to act at a certain time based on a certain price. The buyer must purchase or the seller must sell whatever the underlying asset or commodity is at that time, at that price, regardless of what the market is currently priced at when it expires. For example, a December gold's future contract is a contract that expires in December and the underlying asset is gold. Traders and investors use the term futures loosely, but there are many underlying assets that can be used in a futures contract. For example, you can have a commodities futures. This is on crude oil, natural gas, corn, or wheat. Or you can have a stock market future. This is on a particular stock within the S&P 500. You can also have future contracts on currency, such as what the price will be for a euro in the future. Future contracts also exist for precious metals like gold and silver, and they exist on US Treasury bonds. Now, let's jump into an example of how a futures contract would work. Let's say we're in the month of May, and a trader wants to speculate on the price of crude oil in December. The trader predicts that crude oil will actually go up in value. Right now, the December futures contract for crude oil is trading at approximately $50. The trader locks in the contract. Since crude oil is sold in increments of 1,000 barrels, the trader now owns 1,000 times 50, which is $50,000 worth of crude oil. However, the trader only needs to pay a fraction of that contract right now. This is what's known as a margin. From May to December, the price of crude oil has fluctuated, and if it becomes too volatile, the broker may ask the buyer to deposit additional money, also known as a maintenance margin. It's now December, the end date of the contract, and crude oil is now valued at $65 a barrel. So what does this mean? Our trader has now made $15,000. That's calculated as the $65 value currently minus the $50 contract equals $15 times 1,000 barrels. However, let's say we got to December and the price of crude oil had fallen. Let's say it was instead $40 per barrel. Our investor would have lost $10,000. You see, they paid $50 a barrel back in May for the price of December, but when December came around, it was only worth $40. So they were not able to recoup $10 per 1,000 barrels. Future contracts can be extremely lucrative, but they come with a significant amount of risk. So they're really meant for the savvy investor. While you can win big, you can certainly lose big as well. We hope you enjoyed this latest installment of What is That? Hit the like button and subscribe to our YouTube channel. Follow us on LinkedIn, Instagram, and Facebook at Accounting to Scale. Until the next video, your favorite CPA, Tiffany Gonzalez.